Hey everybody, Ernie Rapp with the Dorian Trader. I want to talk to you about making money with long dated option trades. That's what I have been doing for the last 10 years. Going to create a little episode program here about some of the different rules that I follow and how I make money on long dated naked puts and calls. So let's get started. Making money with long dated option trades. So let's get started by talking about Starbucks. You've heard of that underlying. If you've done any option trading whatsoever, you know that's one of the biggest companies in the world, biggest brands in the world. Let's talk about selling long dated naked puts and calls and an expiration that's 16 months away from today. And is it worth it? Can you make the right amount of money? Well, for me, absolutely. Let's see if I can prove that to you and talk to you about some of the rules that I follow in setting up long dated naked puts and calls. Let's use Starbucks as an example. So what you're looking at right here is a 1 year graph of Starbucks. Not particularly pretty, seeing a high of 115 and a low of 89 during the last year. It's kind of heading down, if you will, over the last year. So if you look at that little picture area here or draw that arrow, it's just kind of heading down, ups, down, ups, down. Starbucks going to be around for a long time. Can we make money selling long dated naked puts and calls on Starbucks? Well, let's blow up a little bit bigger of a picture. This is a 3 year picture of Starbucks where we've got a high of 126, a low of 68, and we're building up a lot of energy right here. You know, it just can't stay in this little range forever. It's got to go up or down. It just has to. Let's see what the analysts have to say. Some of the analysts that I follow say, you know, as of this date, Starbucks is a hold, currently trading in the 90s. Thinks the target price is 102. You got 26 different individuals, probably smarter than me, I'll bet, saying in the last 90 days that they think Starbucks 12-month stock price is going to be between 127 and 95, an average of 107.88. So when I use this information, I combine it with a couple different rules, lots of different rules, but here's a couple of them. So let's set up a long dated trade on Starbucks 480 days away from today. So that's 16 months. And two of the rules, absolute rules when I follow to sell long dated naked puts are as follows. Rule number one, very simple, is that I want to make sure that the strike price that I sell is below the 3-year low. So that yellow line that I just put up there is the 3-year low, and you can see the 60 strike that I've got set up here is way below the 68 price that we saw in that graph just a minute ago. The second rule is on the call side. If we look at that, I have two conditions. Condition one is I multiply the underlying price times 140%, and I also look at what the highest ever price Starbucks has ever been. Those two lines right there on the right-hand side represent those two numbers. And if I can find the amount of premium that I'm looking for above that, I have a pretty good trade. And there's a 140 strike, which is about, you know, call it 45 points away here. And what are we, 35 points away on the put side. So just by being so far away from where the current at the money is, I'm reducing a large amount of risk. That's a pictorial way of looking at setting up a trade, a naked put and a naked call. They're undefined risk trades. Yes, if Starbucks goes out of business in the next 480 days, I'm going to own a worthless piece of paper. And yes, if Starbucks goes through the moon, I'm going to have a really big loss, right? But what are the probabilities of that? Extremely low to go out of business in the next 480 days. And Starbucks is not likely to be acquired or, you know, do something so dramatic that the price exceeds 140% of where it is today in the next 16 months. This is that 1 year picture. Those red lines are my strike prices that I've set up. You can tell, you know, it's pretty kind of a safe area. If you blow it up to 3 year picture, you can tell I'm above the high, I'm below the low. It's in that midpoint. It looks like a pretty good trade. This is actually a 5 year picture. And if we go out even further, this is a 10-year picture. So you can see it's never even come close to $140 a share. It's super far away from that right now. And if we look at the low, yes, 33.97 way down here 10 plus years ago. This is kind of Starbucks as a company back then. This is Starbucks as a company now. Does this history make a lot of sense? Not to me. 3 years is kind of a good perspective. Let's take a look at what this could possibly mean in earning income. And so I've got two pictures for you up here. Picture setup, trade setup one up here is on portfolio margin. And down here, this is regular T margin. So the return on portfolio margin versus T margin is ridiculously awesome, right? So if you have a big account, that trade, a 60 naked put and a 140 naked put, is going to yield you $234 after expenses, and it's only going to tie up buying power of $147. It's 159% return on your buying power. Not so great on T margin, but not terrible either. It's 233.71 over 945, a 25% return on your buying power. So some of you might ask, well, all right, are there other rules that you follow? What are the numbers if you annualize it? Because that's 16 months. How long are you going to be in the trade? Well, one of the other rules that I follow is if I achieve 75% of profits, meaning if I take in $100 of premium and I can buy it back for 25, no matter at what point in time of that 16 months, I'm out. I want my money. I want to reposition the trade. I want to put on a new trade. I want to meet the money that I can keep. It's a process of going in and out of these trades depending upon what the market is doing. If the market is bullish and continuing to go up, you're going to be able to get out of this trade super early. You might have to hold the trade all the way to close to expiration, not quite to expiration. But if you look at kind of an annualization of what that 159% return on investment is on just that portfolio margin. So I did the math for you. You take that 159, divide it by 16 months, multiply it by 12. It's an annual return of 120. If you take 75%, you're still at a 90% return. Real dollars, you took in 234, you buy it back for 25%, leaves you with $176 of profit on one contract. 90% return, and it could be a lot more on an annualized basis if you got out of the trade early. If you look at it on regular T margin, the same kind of math applies. It's a 14% return at 75%. You keep that 175 over 234, you should have a larger denominator. But the long story short is, if these numbers make sense to you and the risk profile makes sense to you, long dated naked puts and calls are a super watching paint dry kind of strategy to earn income in the option marketplace. Obviously, there's a lot of things to consider besides, having strike prices that are way out of the money, up and down, and taking 75% of the profits and running quicker. You got to watch out for volatility, PE ratios, industry history of the underlying, what underlyings to avoid. You don't want to do these on super speculative stocks. Portfolio positioning, buying power usage, earning calls, management changes, mergers, dividends announcements, interest rates announcements. And the very most important thing that you really need to understand to do when you're in the option marketplace is know how to adjust your trades using time and using a lot of other conditions to make sure that you keep your option trades out of the money so that you can earn all sorts of great income over the course of time. It is kind of watch and paint dry, but the reality is I've been watching paint dry for the last 10 plus years and doing awfully well with this strategy. So ask me anything, Ernie at DorianTrader.com. I hope you enjoyed it. Like it if you did. We'll be back with episode 2, topics you just never know. Take care and good night.